I'm Ellis Martin. The following segment is sponsored by CrowdGather Inc., a public company trading under the symbol CRWG. CrowdGather has a recent share price of just 11 cents and has completed a merger with the online gaming company Player, creators of the widely played MegaFame Casino and Slots, downloadable through iTunes and playable through Facebook. Join me for a conversation with a frequent guest of the show, David Morgan, the Silver Guru, an expert on money, metals, and mining, also a lecturer and an author. Mr. Morgan has written Get the Skinny on Silver Investing, available on Amazon.com. His website is themorganreport.com. David, welcome back to the program.
Great to be with you, Ellis.
You've been known for many years as the Silver Guru, the quintessential expert on silver, the go-to guy on the metal. But not too terribly long ago, you morphed the name of your website from silver-investor.com to the Morgan Report, with a focus not just on silver, but a broader scope of investments in general. Let's discuss the reasons behind that change and your current focus as an analyst and newsletter writer. While the resource sector is relatively flat and depressed, the Dow continues to surge past 17,000.
Sure. I started the website, silverinvestor.com, and called the report that for just a couple of years, and then I changed it to the Morgan Report because, one, I wanted to keep writing the financial sector, and two, I thought that it was my duty or part of my mandate to try my best to find something for the membership to look at investment-wise when the gold and silver markets are peaking. And normally that's true. I mean, if you look at Mike Maloney's wealth cycles, he goes through a very good illustration, and so does Jim Poplava. Basically, you can make some very correct investment decisions and wait like in 10-year blocks. I mean, Poplava talks about being in Japanese stocks in the 90s, tech stocks in the 2000s, metals in the 2010s, and that type of thing. And Mike Maloney does a similar one about being, in the precious metals until they peak, and then moving back in the stock market, until it peaks, and moving back to the metals, and building wealth that way, because these things do go in cycles, or there are very large trends, and you don't have to really put a lot of worry and effort in to find out what the mega trends are. My own personal case, being a metals head most of my life, I've certainly always kept a silver position, but really caught on to the cellular phone industry at the inception and brought the idea to my dad, and he did quite well investing in the cellular phone industry. So that was a major investment for him and partially for me during a time frame when the metals were really lackluster and doing nothing. I mean, they had a 20-year bear market. So I want to make it clear to the readership that investing, the overall theme of investing, is something I've been fascinated with from a very early age. I was investing in the stock market when I was 16, and it's something I continue to pursue, and I do look outside the sector. I haven't really found anything that really intrigues me. There's a few areas that we like that we were going to actually put into the report, and they kind of got away from us. But I'm not a big small stock guy, as you well know. These are, I call them special situations. During the process of doing the research and due diligence, it kind of got, went from well undervalued to fair value to overvalued, and that can happen in these smaller companies pretty easily. So anyway, Alice, that's it. I mean, I'm always out there looking. Just because we don't feature general equity investing doesn't mean, or other investments. I mean, real estate would probably be a great investment at some point in time. I mean, Mike Maloney makes that point too. I think his plan is moving out of the metals at the right time and back into the real estate market, and that may be. So that's it. I mean, I probably belabored the point, but it's a point well worth making, is I'm not going to leave my readership in the lurch, so to speak. When I see the topping in the metals, I want to be able to make suggestions, and maybe the suggestion would be to hold on to cash. I kind of doubt it because of my beliefs about the currency system, but we'll just have to wait and see. I don't want to project anything. I want to be open-minded because it's important to stay open-minded, which means I'm going to be able to evaluate it more real-time than I can do right now.
There's a sponsor company that we've been covering on the Ellis Martin Report, which is certainly outside of the resource sector. It's in the business of producing, developing, and purveying online video games, downloadable as smartphone mobile apps, and playable through Facebook and iTunes. Now, I know this is not something that you personally involve yourself in during your free time, but millions of people potentially do. The company is called CrowdGather, trading under the symbol CRWG, with their MegaFame Casino and Slots games. And this company generates revenue and is on the road potentially to profitability, something that most of the junior mining companies are not experiencing necessarily. CrowdGather is trading near their book value at under 13 cents. I know that you're not familiar with the company, but there again, it's not the type of company where you've got to pour money into the ground, wait for feasibility studies, wait on the market to come around again. It's entertainment driven, and entertainment is always very popular in this country. If I were to suggest that you take a look at a company like this, what is your criteria?
Yeah, that's great. It's a process, and basically the process is similar for almost any company. There's a little tweaks and caveats when you're looking at a mining company that are different than looking at an overall general equity or general company that's listed on the stock exchange. But the basics are the same. It always boils down to people. I mean, that's really something I've learned from experience primarily, but also, I haven't said this in a long time, but Dr. Bill Green and I, we're not as much anymore since he retired, but very close for a long time before I moved to Spokane. And he told me it's all about the people. If you get the right people, they'll just keep working until they find it. And he's referring to as the mining business. If you get the right team, the right people, and they're sincere and heartfelt and really working, they're going to keep going out and drilling or finding new properties or projects, and they're just going to keep going until they make a discovery. Usually it's trying to find out as much as you can about the management team, what their intent is, and sometimes you can't. And if you can't determine what the management team has done or what they're about, then the next best thing you can do is find out how much they have in the game. If this guy has sold a prior business and put 30% of his net worth into this company, you've got a pretty good idea that this guy is very sincere about it. Whereas if he's a promoter type and he's really got a bunch of free stock that he's going to spin off to the public at a higher price, then you've got to be very, very cautious. So that's number one. Do as much due diligence on the people as you can. Then, it goes down from there. And the next thing that I look at would be, what is the company? I mean, is it profitable? Isn't it profitable? And in small startup stages, that's almost impossible. Of course, this one you're talking about sounds like it's profitable. I'd kind of skip a few steps. I mean, if it's got book value and if it's selling under book, that's very tasty right there. I mean, who doesn't want to buy a $5 bill for $3.87, which is just an illustration of a company that has a book value of, $4, and you can buy it less than $4. You're basically buying it for under the breakup value. So that's tempting, but you also have to look at the cash flow, and that's something most people, not because they have a finance degree or anything like that. It's pretty common sense, but a lot of people kind of overlook it. They look at, this is a $2 billion company, and they get the idea that they make $2 billion. Well, they might make $2 billion, but spend $3 billion. So they get confused with these large numbers of whether the company's profitable or not. So that's what you need to look at. What is the cash flow? What's the burn rate? It might be a great product. How much competition do they have? There's a lot of aspects you look at. You look at the management first. You look at if they have something in it. In other words, they're really sincere about it. You look at the technology or the company, what its product is or what it's doing. Is the market saturated? I mean, right now, for an example, going back to what I said a moment ago, if a new cell phone company came out and said, we've got this, I would be very leery buying into any new cell phone product because the market is so saturated. There's so much competition. The margins are so low. That would be something that I might miss. It might be something so innovative and so outstanding that you can make money with a new cellular provider of some type. I would just automatically dismiss it. Because as far as the video game thing, that's still an emerging market, even though there's tons out there. It's becoming more and more of a mobile thing. I mean, the new generation, these people basically don't own laptops. A lot of them don't even own pads. They only have phones. And they have no intent of buying a pad or a laptop, sort of a dinosaur for that generation. So a lot of the stuff is mobile apps. So there's certain video games that are more, let's say, enticing on a phone platform than they are, let's say, on a pad or a computer base. So there's a lot to look at. And then, of course, I would definitely just, after I did that armchair analysis, I would make an appointment, if I could, to talk to management. And there's a lot that can be said because it's just a conversation, and preferably face-to-face, but because you can get kind of a feel, and this is a little esoteric, but not too much. You can, especially at my age and having done it for so long, you can almost tell by the tone and the intent, the sincerity of management, which means you kind of get that, what's called goodwill in finance. It's an intangible. This is what Pepsi and Coke and a lot of big companies have. They have what's called goodwill, and you can look it up on the internet. But it means that there's something about the product that gives it value because it's so well recognized or so well respected or so well known. And again, these are all intangible things. And every time I go that extra step, it seems to be worthwhile that I've done that, because every time I have, it's sort of given me that extra little piece of information, maybe even emotionally, that tells me that, you know what, I think this is worth taking a shot on. The last thing is, if it's a small company, then I've always taught and always will, bet a little to win a lot. A lot of these companies might become the next big thing. It's rare, but it happens. And so you can start with a small investment. And as the company grows, you can put more money into it. But it's got to prove it to you. This is similar to how I trade in the futures markets. I mean, I have gotten away from myself, kind of taken a back seat and tried to not look at what I want or think or see. It's what the market is doing and taking a position based upon what the market's doing. So if this company starts growing and the revenues start increasing, as long as the stock is not reflecting that in its price, then you could be fairly confident of buying into the company because you've been following it closely and knowing that this company's growing its revenues, all the things are working favorably for the company, but it's not reflecting the price yet. And we've done that with a few of our speculations. I mean, I've probably used the example too many times, but Western Copper that became Western Silver. I mean, we started that as a rank speculation, but as the company started to mature and grow, we went ahead and added money to it because it was a going concern. And Bill O'Neill, the founder of Investors Business Daily, teaches that as well. So it's a different investment when it's a different company. I mean, if it's a little startup and they're barely making it, and it's a hope and a dream, that's a rank speculation. But if they start making revenues and they're leader in the field and they're in the top 3 in that category and that type of thing, and the market hasn't recognized it yet, geez, that's a pretty good opportunity to go ahead and add to your position. But you don't want to do it because someone from the IR department told you that it's going to do that. No. And that's where a lot of people, especially on these small story stocks, they buy the story. Don't buy the story, buy the real deal. In other words, when it becomes evident, then you can make a change in your investment philosophy, but not until then.
Well, that certainly is sound advice. I don't think I've ever invested in a company without meeting management in all the years that I've been an investor. That's basically what you're saying, correct?
Correct. That's right. I mean, I think, I gave you a pretty good outline. Hopefully it's beneficial to everybody listening to the Ellis Martin Show, because it's not that difficult. It's just interesting. A lot of people rely on people like me to do the due diligence, or at least the initial due diligence, let me phrase it that way, and then go on from there. And I'm happy to do it. I love it. It's a passion. It's something I've done for years and will continue to do. But, ultimately investing decisions come down to the individual investor, because I don't know what your net worth is. I don't know what your risk tolerance is. I don't know what your ages are. I don't know what your objective is. All that stuff is something that you have to take to the next step. The kind of stuff I teach and do myself personally, believe me, most of the stuff I learned by making mistakes, because when I made a mistake, I try not to repeat it, which means I've gone on and become a better investor over years, and every time I repeat a mistake, I really kind of beat myself up because I don't wish to. When that all takes place, I just become more and more seasoned and skilled at what I do. It doesn't mean I don't still make mistakes, but I do them in the correct context. Bet a little to win a lot. When I make a rank speculation, it doesn't work out, and then I'm blowing up about it because I hadn't bet the farm. These are all important factors that, for me, it's taken experience, it's taken the mistakes to learn them, but I've learned them very well, and I'm very happy to pass them on, because it really is a heck of an opportunity. I mean, we've talked about this before, but most people want to have their own business, and when they do have their own business, they really don't have a clue what to do. Well, the stock market offers the opportunity to be in your own business. I mean, you can be the part owner of the most profitable company on the planet if you want to. You could Google right now what the 10 most profitable companies in the world are and be part owners of them. And you don't have to leave your office. You don't have to change jobs. You don't have to make a big educational move and get another degree. You don't have to do any of those things. You can sit on your butt, do a quick analysis, especially the internet, and determine what these profitable companies are and become part of them, an owner of a company. But people don't look at the stock market that way in most cases. At least that's what I have found. They invest the wrong ways. I mean, as I said before on my epitaph, I'm going to have, people love to buy cheap stocks. And as Bill O'Neill says, cheap stocks are cheap for a reason. Now, I'm not putting down this company that you're talking about, because it's a startup and they've got an idea and maybe it's going to work out wonderfully. In fact, I hope it does. But a cheap stock that remains a cheap stock remains a cheap stock for a reason. I can certainly say that with authority. And a cheap stock that moves into higher and higher price valuations does it because they're on track, notwithstanding the pump and dumps, which do take place. I mean, I don't think there's any way around it. But there's usually a way to determine whether or not that is going to take place. And again, it goes back to looking at the management seeing if they have anything in it, and interviewing them. If you can't interview them, maybe you can make that a rule. So, if I can't talk to management directly on the phone, I really don't want to invest in it. You might miss one or two, but by missing one or two, you're going to save yourself a lot of heartache, because the small company, I'm not talking about multi-billion-dollar corporations, you're not going to talk to the CEO, but I'm talking to small startups. If they're not willing to talk to an investor, then usually there's a reason for that, and you want to determine what that reason is if you can.
There again, not all of our listeners can actually talk to the company. They probably don't have the kind of access that you may have. That's a great deal of what you do on the Morgan Report. How does one become a subscriber?
Yeah, I want to add on to that, because I have the ability to circumvent the secretary, the receptionist, et cetera, because of what I do. So I have more clout to get to the management, where the individual investor may not. So I want to make that clear. Best thing is just go to morganreport.com, get on the site. You can get our free letter that comes out every week. You can look at the membership services over on the right-hand side, or on the subscription page. It's pretty detailed what we do. And remember, you can try for 30 days for free, which means you get to look at everything I've done over the last 16 years on the website and test it. It's hard to explain everything you get without jumping in there, so you can just sign up, test drive it, if you will, for 30 days. And if it's not for you, just let us know, and no harm, no foul. Every time that we get somebody in there, they're usually kind of startled at the amount of information and the amount of resources that you are getting for the price that you pay for the basic service, around $10 a month. Pretty cheap, couple Starbucks coffee, and this is, my life's work, my passion. 2 analysts besides myself, one of the best webmasters on the planet, a staff of 5 private individuals that work on our video stuff, do our editing, take care of our Facebook and Twitter. I mean, there's a lot involved in this. It's not, a lot of people who want to run an internet business don't really realize the amount of time, energy, and effort it takes to get to a level where you can make a living on the internet. I would say, from my experience, it was a little easier said than done, but of course we're doing and continue to do so. But a lot of it is for the benefit of our members. And the other way to understand that is, every time you go in and see what you really get, most people are very happy that they did take that leap of faith and join and become a member of Morgan Report.
Well, David, as always, it's a pleasure to chat with you. Thanks very much for joining me today in the program.
My pleasure. Thank you.
I've been speaking with analyst and newsletter writer David Morgan of themorganreport.com. You can hear this segment again on the podcast page of our website, ellismartinreport.com. The preceding segment was sponsored by CrowdGather Inc., trading under the symbol CRWG. Just type in CRWG. CrowdGather is a paid sponsor of the Ellis Martin Report.